How y'all doing today? Hope everybody been good. Hope y'all had a good start to the New Year's. I wanted to drop in and give y'all a quick little video. In today's video, I want to talk about why saving money might not be enough. So I feel like a lot of times when it comes to finances and money, a person might ask, why should I be investing? And one of the first videos I did, I was talking about the Rule of 72. And I had came across it in a book I was reading, and also these people I be watching, the Black Wealth Rebels, they was talking about it. And the Rule of 72 shows you how long it would take for your money to double. So in this example, we have 5,000 in a savings account, and we have 5,000, say you put it in the stock market. And with the savings account example, most of the time, they don't really grow at all, but let's say it's growing at 1% annually just for the sake of the video. So with the Rule of 72, you take 72 and you divide it by the annual growth rate. So if we had 5,000 in a savings account, how long would it take to double to 10,000? And we're going to take 72 and we're going to divide that by that 1%, and that equals 72 years. So that's telling me it would take 72 years if I had 5,000 in a savings account growing at 1% annually to double to 10,000. Super duper long time. I'll be 90 something. I don't want to wait that long. Compared to if I had put it in the stock market, we just taking 10% on average, 72 divided by 10 equals 7.2 years. That's a lot faster. And even that 10% taking 7 years, that should get your wheels rolling to, okay, what about if I have the in the investment vehicles going at 30%, 40%, you know what I'm saying, getting your wheels rolling. But that's the Rule of 72. And with me showing y'all the exercise, don't take it as I'm saying don't save no money. Definitely still need to be saving. Saving is super duper important. Remember we talked about an emergency fund. Having 3 to 6 months of expenses saved, because life gonna continue to happen. Whether your car break down, you out of work, you gotta give, you letting your family member hold some money. So we still want to save, and even beyond the emergency fund, we want to just save in general. A lot of times we can save when it comes to various goals, whether it be like a down payment or a big purchase, but just saving in general is really important along our financial journey, because it gets us out of that check to check phase, that survival mode where we worrying about how I'm gonna pay the rent. I gotta ask this person for some money. I got, you know what I'm saying, getting us above that water, and we could think clearly and we could think ahead. So beyond, okay, when we get our check, we pay our bills, we have money left over, making sure we put in a percentage of that money towards savings. But beyond that, we will also want to think about how can we protect our purchasing power. So if you have 5,000 in a savings account, or if you have 5,000 in cash, it's just gonna stay 5,000. And you gotta think, inflation eating that 5,000 up. If it's just sitting there, it ain't doing nothing. So with inflation, prices getting higher, that's having it where your purchase power is decreasing. The more time go on, the less you can buy with your money. So we want to have it where we possibly want to start thinking about, okay, where could I put my money, some of my money, to where it's working for me, it's growing, so I can have it where my purchasing power is preserved, is protected. Because the way our money system set up, the government, they're just going to keep printing money, putting money into the economy. And like I said, you have it where dollars chasing the same products. That's just going to have it where prices are going to continue to rise and your purchasing power is going to decrease. And if you look at these past couple years, that's a prime example. Remember in COVID, it was a lot of money in the economy and everything was good. But now these past couple years, we've been able to see where we feel that inflation because things are a lot more expensive. But it's going back to what I was saying last week, like what side we're going to be on. We're going to be consumers forever, or eventually we want to get onto the side with the investors, because they getting richer on that side and because they know how to play the game. And it's one of these things where if you look at, okay, things have been so expensive as consumers, whether it be groceries, we also had to look at it where these assets, they're inflating as well. And with inflation, you look at it where prices are higher, things cost more, but also look at it from the perspective of it costs more dollars to buy that thing. So same with these assets, it's costing more dollars to buy them. And with them inflating, that's not always a good thing, because you have it now where we're in a bubble. in the short term, but in the long term, especially, like if you zoom out for years and years and years, over the long term, you put your money in the right places, it's gonna appreciate in value with the assets. So that's what we want to start thinking about putting our money at. So let's try to dive into the video a little bit. Today I'm gonna talk about what is money. I'm gonna talk about fiat money, and we're gonna talk about the gold standard. So trying to bring all those three into one big video, and give y'all a couple book suggestions before we get started. I'm just talking surface level talk today, but this book I definitely recommend. It really showing you like how the money system works. The Creature from Jekyll Island. And like I said, we surface level today, but this book dives super duper deep, and it really open your eyes to like how the money work. And this is like my third time reading this book, because I ain't gonna lie, the first time I read it, I was like, oh man, it's too deep. So then a couple months later, somebody else was talking about it. I was like, okay, let me read it again. So the second time, it was a little bit better. Okay, I started understanding a little bit more. Then the third time, I started understanding, so it's one of the things where I was talking about playing the game as an example. When I watch my little brother play the game, I don't really know what's going on because I don't play the game that much. But he play it all the time, so he knows. So the more you just become familiar with something, the more you know. Excuse me. So that's why I'm at with it. Like, it's starting to make a lot more sense to me. Excuse me, my bad, y'all just ate. But it is a long book, about 600 pages. If you don't want to read the book, I got a couple. My bad, y'all. A couple documentaries as well. So The End of the Road, How Money Became Worthless. It's talking about like the Federal Reserve System, the money system, money for nothing inside the Federal Reserve. And this one is Jekyll Island, the truth behind the Federal Reserve. And with the Federal Reserve, that's basically like our central bank in America. Like it's the big dog when it comes to the money. It make the decisions. It's talk about monetary policy. We talking about raising and cutting interest rates. So that's like the big dog when it comes to that money. With these two documentaries, this one talks about these two talk about the creation, but they talking about what's happened more in like recent history. This one dives real deal deep, going like 200, 300 years, like how it really started, even going back to England, and you know what I'm saying. This one dives super duper deep, and it's on this weird website. I'm gonna put the link in the YouTube, but it's a really good. Like I said, if you don't want to read the book, at least check out the documentaries, because really understanding how the money works can help us understand what to do with our money today. Because if you look at history, a lot of what's going on today, we just sort of kind of been here before. Like history ain't nothing new under the sun, you know. So let's get into the video real quick. Oh, I forgot one. Let me see. It was another book. What's going on? I seen what was happening with Venezuela, and this book made me think of this book, The Confessions of an Economic Hitman. Just going off on a tangent, but this is a really good read too, of like really seeing like how things work. I definitely recommend this book too. Confessions of an Economic Hitman. It was a good read. And let me recommend one more thing. I done went off on a whole tangent. Talking about the Federal Reserve, I stay in South Carolina, so that's why I say the Federal Reserve Bank of Atlanta. But if you're ever in the Atlanta area, go check out the Federal Reserve Bank. Definitely pretty cool. Like, it's you'll be in there about 20-30 minutes, but you're gonna see some cool stuff. You can't have your phones in there, that's telling. But you're gonna see like the history of money in a sense. Like, you're gonna see official gold note, like money paper notes from back in the day. You're gonna see a look into the future, like how they gonna do transactions in the future. You're gonna see a real gold bar. And the coolest thing, you're gonna see probably the most money you ever seen in your life. I ain't never seen that much money. So if you ever in the Atlanta area, go check out the Federal Reserve Bank of Atlanta. Or I guess if you're in any of the areas where they have a Federal Reserve Bank, because they have 12 branches throughout the country. I don't know if all of them for where the public can, but I know for a fact in Atlanta, I think you can still go see it. So definitely go check that out. But let's get into the video. And I had y'all a slideshow today, or I had y'all a PowerPoint, but I ain't finished it. So we're just gonna freestyle. So for one, we were just talking about taking a step back, like what is money? And we all have a definition of what money is, But me personally, I didn't know what the definition of money was from like an economic perspective. So when we have money, you have you had three main functions of money. One of them is being a medium of exchange, something people can use to buy and sell from one another. Two, you have a unit of account. That is to provide a common base for prices. So you can measure like how much something costs and things. And three, you have a store of value, which means people can save it and use it later, smoothing their purchase over time. And with the store of value, that's really important because you have something that's lasting over time. I think gold is a perfect example. If you look at gold, that's been used as money for thousands and thousands of years. Even to this day, gold still holds value. So that's an example of a store of value. And with the medium exchange, like before we had money, they had it what we call barter. So you might have it where I work on a farm and I have chickens, and you work on the other farm, you have apples. So for us to trade, you gotta come. I might give you some chickens, and you give me some apples. But with the barter system, it got sort of kind of complicated with the most sophisticated societies got, because they call it a double coincidence of wants. So if you got apples and I got chickens, what if I don't want your apples? Now we got to find somebody else to, make that trade go through. So with barter, that's where money came in. So now if you got some money and you want some chickens, you give me some money, I give you some chickens. So that's where the money play came in. And even throughout history, we done had all types of, you done had seashells as money, you done had weed as money. Like, you go through history, like, it's been all types of things as money. And let me see. And then we'd have, like I said, gold and silver still, to this day, that's still considered valuable in money. But we had all kind of money throughout history. But today, in present day, we have what we call fiat money. So with fiat money, let me see, anyone who won. Fiat money is basically money that is not backed to anything. And I'm going to explain what that means. But fiat money was born. We have fiat money is materially worthless, but has value simply because a nation collectively agrees to ascribe a value to it. So that's how our money system works today. It's like it's backed by the faith of the government. And we had, before fiat, we was on a gold standard. And with the gold standard, that is basically where you can't print more money than you have gold. So what I mean by that is, let's say I have an ounce of gold, and let's say $100 is equal to 1 ounce of gold. If I'm a country and I have 1 ounce of gold, I can't print no more than $100. And what the gold standard did is it sort of kind of held us responsible, because you'll see throughout history, if you have it where people could just print and print and print, usually it eventually comes to an end. And that's where we at today with our money. And like I said, before it was on a gold standard, and even going back to, okay, let's start with the 20th century, you had it where, for the most part, America was always on a gold standard. So you can't print more than gold you have. So your money is linked to gold. And the reason being, because gold is, like I said, it's considered valuable. It's considered real money. It's considered hard money. It holds its value over time. So if we go back to the 1900s, so remember, we have it where we got the 1920s, and it was really prosperous. Everybody was buying stuff on credit. We was doing good on paper, but it was building a bubble. The Roaring Twenties, for whatever reason, I could not remember that, but we had the Roaring Twenties. But remember, that came to an end in 1929. That bubble popped, so we had the stock market crash in 1929, which led us into the Great Depression. So in 1933, FDR became president, Franklin Delano Roosevelt, and when he became president, he had to do something to get get the ball back rolling. So with that stock market crash and everything just horrible, we had what we call a lot of bank runs. And what a bank run is basically the way banks are set up today. They call it fractional reserve banking. So I'm showing y'all an example. Usually, if you go into a bank and you deposit your money into the bank, 9 times out of 10, they're not keeping all that money in there. Reason being is, why would they let that money just sit there when they can go put that money to work and make money off that money? And how that work is, let's say I go to my bank and I put 1,000 into my savings account. The bank keeps 10% in reserves. Not always 10, like it just depends what whatever the I forgot what it's called, like reserve rate or something like that. But let's say it's 10%. So the bank keeps 10% in reserves, fractional reserves. So your bank, they hold on to 100, 10% of 1,000, and they lend out the other 900. So another customer comes in and he asks for a loan of $900. They give him that loan. He go get his car fixed with that 900. He get a car repair shop the money. The car repair shop go put it into their bank. So they put 900 in their bank, and they bank puts 10% in the bank, $90, and lends out the other 810, and they basically just keep going. So they call it, and it's just expanding the money supply, and that's sort of kind of how banks work today. And back during like them times when that happened, remember with the stock market crash and all that, everybody was scared, everybody was panicking, so everybody was running to the bank. So this is where the problem come in. If I go to the bank and I get my money out the bank, it ain't really that bad because I'm just one person. But with these banks, they didn't keep the money in there. They just kept lending it out. So what about when a lot of people come at one time for their money? It's a big problem because these banks ain't got the money. And in them times, like a lot of people's money was just disappearing. Like they couldn't get it out. If you go to the bank today, you see like the FDIC, like the 250,000 federal, insured. That's where that came. That's how they created that, because they had to protect people from where you just put money in your bank and you can't get it back. So that's where the FDIC came in. So we in the Great Depression, and remember we said fiat money, and we talked about gold. Gold is real money. So a lot of people was going back to gold. They was going away from the paper money because it wasn't really valuable to them. So a lot of people started getting gold out of the banks. And when they was doing that, it was sort of kind of messing up the government, because what they was doing with the government is they're saying, for us to get back rolling and get us out of this depression, we're going to have to expand the money supply. We're going to have to create money. So remember what I was saying, back then we used to be on a gold standard. So you can only print as much money as gold you have. If people taking all the golds out the bank, we ain't got no money. So what FDR did is he had a couple of like executive orders where he essentially took the money from the Americans. He made a rule where you had to turn in your gold. He made it illegal to have gold, basically. So you had to turn in your gold to the Federal Reserve, and in return they would give you paper money. So back then gold was like $20.67 an ounce. So you'll go turn in your gold and they'll give you paper money in return. So when he did that, it was putting money back into the gold back into the government. So now they could print more money essentially, and he inflated the money. So what he did is, once they got the gold back, and I ain't really do too much of a deep dive into like how many people turned in their gold, how many people kept their gold, because like I said, it was a law. So if you did get caught, you had to do either 10 years or a $10,000 fine, and that was $10,000 in 1933. So that's worth way more today. But I didn't really look at like how many people actually complied with this. But this was 1933. He made everybody turn in their gold. So I'm pretty sure they got a good amount of gold out of that. But in 1934, remember, 1 ounce of gold is $20.67. In 1934, he inflated it and he made it to where 1 ounce of gold was $35. So just like that, the dollar lost all that value, because remember what I was saying, it costs more dollars to buy the same thing. That's inflation. And the reason he did that, he was trying to expand the money supply. But think about that as a person. Like, let's say if that happened today, where we back to hoarding gold and the government make you turn in your gold. So You turn in your gold and they give you money in return, $20.67 for an ounce of gold. But then they turn around and they make that ounce of gold even higher. You just lost so much value in your money. So that happened in 1933, 1934. It was illegal to own gold in America from 1933 to like the 1970s. I ain't never know that till like a couple months ago. That's pretty interesting. But so that was sort of kind of like tipping us toward getting off the gold standard. We was domestically you couldn't own gold, but we were still doing business with gold internationally. So then remember we had World War II. So they had the Bretton Woods Agreement. And with the Bretton Woods Agreement, remember America, before America was the world power, like the number one country, it was Britain. So with World War II, well, they were sort of kind of the number one world power before this, but after World War II, this Bretton Woods Agreement, like they officially became that. So the U.S. dollar was like the world's currency. And with the Bretton Woods Agreement, they had it where the countries were tied to the countries where could exchange their money for U.S. dollars, and the U.S. held the gold. Excuse me. So the countries that participated, they could exchange trade their currencies for U.S. dollars, which they could exchange for gold. So this meant all the countries was under this agreement was backed by gold essentially. And out of this, you got sort of kind of like a world central bank. So you got the IMF and you got the World Bank. And I'm just looking at my notes, y'all. Because, let me see. And the price of gold at this time was $35 an ounce. So the U.S., the countries, they can, you know what I'm saying? So in the 1950s, 1960s, the U.S. had a lot going on. They were spending a lot of money. So remember, on a gold standard, you can only print as much money as gold you have. The U.S. was going into deficits. They was spending more money than they had in gold. Because you remember we had the Vietnam War. War is really expensive. They had all these different programs and stuff. So countries, like all the other countries started getting suspicious. Like, hey, they started trying to get their gold back because they knew that the U.S. was spending more money and they didn't have as much gold as they were saying. So they had it where the U.S. was like, oh man, they coming to get our gold. They can't have a run on gold. Remember what we were just talking about with the banks? Like, everybody trying to come get their money. All these countries started trying to come get their gold. So the U.S., in return, what they did is they put, in 1971, August 15, 1971, President Nixon, he made the rule where he took us out the gold standard. They call it the Nixon shock. And basically, then forward is where there was the money wasn't backed by gold anymore. Essentially, it was worthless. And ever since then, we've been on a fiat currency. So the money is not backed by gold. It's just backed off the faith of the government. And giving y'all a couple quotes from the Federal Reserve of like what fiat money is. And this is from the Federal Reserve, the horse's mouth. So this from the Federal Reserve Bank of Chicago. And this one I was reading the Jekyll Island book. He was quoting it. In the United States, neither paper currency nor deposits have value as commodities. Intrinsically, a dollar bill is just a piece of paper. Deposits are merely book entries. Coins do have some intrinsic value as metal, but generally far less than their face amount. What then makes these instruments, checks, paper money, and coins acceptable at face value in payment of all debts and for other monetary uses? Mainly, it is the confidence people have that they will be able to exchange such money for other financial assets and real goods and services whenever they choose to do so. This partly is a matter of law. Currency has been designated legal tender by the government. That is, it must be accepted. Now, let me read. Let me see. There's another one I have found. With depository. Hold on, y'all. And this is from the Federal Reserve Bank of New York. And this is talking about fractional reserve banking, or just debt in general. First of all, let me state the simple fact that when you deposit money in a bank, the bank does not put the money into a safe deposit vault. It invests your money into many different forms of credit, in bonds, and commercial paper, in mortgages, and in many other kinds of loans. In other words, the bank puts your money to work to keep the wheels of industry and agriculture turning around. A comparatively small part of the money you put into the bank is kept in currency, an amount which in normal times is wholly sufficient to cover the cash needs of the average citizen. In other words, the total amount of the currency in the country is only a comparatively small proportion of the total deposit in all the banks of the country. So it's showing you like the Federal Reserve essentially prints money they make money out of debt, out of nothing. And then I got one more quote for y'all. And then I got this last one from the credit manager of the Federal Reserve Bank in Atlanta. If the bank loans were paid, no one could have a bank deposit and there would not be a dollar of coin or currency in circulation. This is a staggering thought. We are completely dependent on the commercial banks. Someone has to borrow every dollar we have in circulation, cash or credit. If the banks create ample synthetic money, we are prosperous. If not, we starve. We are absolutely without a permanent money system. When one gets a complete grasp of the picture, the tragic absurdity of our hopeless situation is almost incredible. But there it is. And basically, like, just reading that is sort of kind of scary because it's like, for one, from my perspective as a beginner investor, me trying to, these past couple months, been trying to learn like the macroeconomics, how the money system work, you sort of kind of realize like, dang, boy, it's crazy for real. Because in the book, I was reading The Creature of Jekyll Island, I was talking about, he was talking about with Andrew Jackson, the president, in the 1830s, we got the Federal Reserve today, the one that was created in 1913, and it's still here today. But before that, they was trying to create other Federal Reserves, and in this one, they had one, and Andrew Jackson was completely against it. And I think his story is a little interesting because he was the first president ever. He was the first and last president ever to pay off the national debt. And if you look at it, we $38 trillion in debt today. But if you look at back then, obviously it wasn't that much. But he was the first and last president to pay it off, where we didn't have any debt. And also he had it where, he was the first and last president to pay off the national debt, and he was also the first president to have an assassination attempt on his life. He made somebody really mad, and with the assassination attempt, they shot two guns. Well, they didn't shoot, both of them jammed. And just picking off that, just even like a little Google search to get your wheels rolling, and like, what would happen if the U.S. paid off all its debt? If the U.S. paid off all its debt, it would likely trigger a severe economic depression, as U.S. Treasury bonds are a cornerstone of global finance, providing safe investments. Their disappearance will remove a major asset, forcing investors to risk out options, crippling the Federal Reserve's monetary tools, and removing a massive pool of savings and collateral, leading to an economic contraction. So that's pretty interesting. And, that's where we at today with our money system. So we have it where we have a fiat currency and it's not really backed by nothing. You have it where the federal government, they could just print money uncontrollably and what it does is create problems. But how they do it is they do it where they print money now for the short-term fix, and down the years and later down the line, it'll give us even a bigger problem. And it just keep doing that till the problem gets so big you can't really fix it no more. And, that's what I was saying in my last video. As a beginner investor, which I am, sort of kind of just take you through my thought process of why I'm trying to get into certain things beyond savings. Because if you just saving all your money, inflation going to keep eroding it. Because as you see, like, we have a system where they just keep printing money. And when you keep printing money, your dollar's going to keep chasing the same products, which leads to higher prices. And it's like, okay, save, get your emergency fund, keep saving. But you remember we was talking about when you putting a percentage of your check toward you putting a percentage of your check towards different things. Put a percentage towards savings, and definitely put a percentage towards different investments. Whatever you putting your money in, whether it be your business, your Bitcoin, if you have art and you see art is going up in value, what I'm saying? Whatever you put your money in, we definitely need to start thinking like, what can I put my money in beyond just savings? Because like I said, the inflation gonna keep eating at your dollars. But if y'all have any questions, man, definitely reach out. And let me also say, I probably explained something wrong. If I did, just politely correct me in the comments, because like I said, this stuff can get really, really confusing. But if you made it this far, man, truly appreciate you. Like, comment, subscribe, tell a friend. Thank y'all. Y'all stay blessed.